We've had some cooler than expected inflation data out of the U.S. this week, supporting the bond market. But with policy uncertainty around the Trump White House, inflation fears perhaps still lingering under the surface. What should investors be thinking about? Joining us now to discuss is Sam Chai, VP for Active Fixed Income Portfolio Management at TD Asset Management. Sam, great to have you back on the program.
Pleasure to be here.
As we showed, there's some relief, I guess, in the markets right now, whether it's the equity markets, the bond markets, which you obviously specialize in. Someone might take a look at this inflation print out of the States and say, well, 2.9% headline inflation. Isn't this what we expected? What's happening beneath the surface to have this rally kick off?
Sure. Let's dig in a bit more to the data released today. So we had U.S. headline and core inflation printing for December at 0.4% and 0.2% month over month. So the headline inflation came just around consensus, but the core inflation actually surprised a bit to the downside, 0.2% printed versus 0.3% consensus. And I'll just note that this is actually the lowest core inflation print we have seen since last July. Sequentially, we see that the headline inflation actually has been increasing over the past months. And for December, it's actually primarily driven by energy prices. But more importantly is the core inflation price, because that's more showing the underlying inflation strength in the economy. And sequentially, we actually see the December print decelerating. In fact, if you look at the 3-month annualized trend, we are now printing at 3.3% for core CPI year over year versus 3.7% last month. So all these are very welcoming news. And looking a bit more at the details there, core goods, core services, and the Fed's favorite, the super core, had all decelerated sequentially as well. On the core goods front, if you look at the used cars and new vehicle prices, those actually increased less than feared. So that's actually contributing a bit more to the downside surprise there. On the core service front, shelter component is the most critical to watch. If you look at the 3-month or 6 months annualized trend, we see a steady, slow but steady trend lower as well. So again, good story there. And we know the Fed cares even more about the PCE metrics. And we'll have that data later this month, but if you just estimate based on the CPI and PPI data we have right now, we see that the pass-through to core PCE could be even more benign than the core CPI side. So it likely prints around 0.2% month over month, and that is showing the Fed that there can be a bit more disinflation progress down the road as well. And this print, probably does not remove the base case that the Fed will skip January. It likely increased the odds that we'll have a rate cut in March.
All right, so expectations start to shift. If we go back just a couple of days, on Friday we had a stronger than expected U.S. jobs report. That had the market thinking very differently about the path ahead. We're only, several days later. Does this CPI print make us perhaps not completely rethink that jobs report, but sort of shine it in a different light for us?
So, you pointed out, very, very accurately, which is that we have a meaningful upside surprise in labor market data and a sort of very reassuring downside surprise in the CPI data here. So, to maybe put it into context, our current base case is that the Fed will skip in Jan and perhaps deliver another cut in March. That's more of even odd to us, and maybe 1 or 2 cuts more after that. The CPI data we mentioned is, reassuring that front, supporting that view. The labor market data last Friday, however, is an upside surprise and does show that the labor market is retightening. And I do think that there is a risk that the Fed is becoming slightly more concerned about that, post a pretty aggressive rate cut that's been delivered since last September, and also post-U.S. election. So could the labor market be refirming? That's a question that they will be asking. But nonetheless, when you also think about the Fed's forward guidance last December, that is the Fed really saying that we could be looking at more of a quarterly pace of rate cut if the data confirms to this. But given that the policy rate still is above neutral at this point, and that the data is showing sort of a mixed signal, I think this quarterly pace rate cut can still be the go-to base case at this point.
Now, before we got this cooler than expected inflation, core inflation print, we've had the U.S. 10-year Treasury yield on a pretty significant march higher. I mean, it really began in September, took a bit of a breather, reignited again through the end of last year. Where do we see, are we supposed to understand this move in the 10-year, and where do we think we might end up on these moves?
Yeah, so last September, it's marked like around the 12th of the 10-year rates. And since then, it has increased roughly 100 beeps, notwithstanding today's move. And I think one way to look at it is to break this down into two phases. So the first phase, around September, is really the pricing out of a harder lending risk. Recall last summer, we had quite a few of pretty weak labor market data. Risk assets are also in a corrective territory as well. So the market is starting to fear that, okay, are we heading more towards a harder lending scenario? And that also prompted the Fed to deliver a 50 beeps rate cut on the get-go in September. But by the end of September and as we go into October, the data has been gradually improving again. And that really calms the market and makes the market recalibrate from a harder lending outlook back to a soft lending scenario. So that priced out a few of the more excessive rate cuts. And then come the second phase, which is that from October onwards, the U.S. economic data just continues to surprise to the upside. If we look at, whether you look at labor market or inflation data, those has been very strong. Adding on to that, we had the Trump sweep election scenario as well. The market expectation is that we can see net reflationary impact from that. And so combined, the market has priced out even more cuts to the point that before today's print, market is expecting a very shallow cutting cycle, basically just one more cut from the Fed before the Fed can be on an extended period of hold. So that's one way to look at it, by phases. The other angle we can explore this is by looking at the nominal yield has obviously moved up, but it's driven by two major components. The first one is the inflation expectation, which with the strong energy prices, better than expected, or should I say upside surprise to inflation CPI prints, the higher inflation expectation did drive higher rates. But it's not the key driver. The key driver is actually higher real rates. And that is encompassing both a higher long-term neutral rate, but also just higher term premium. Basically, investors are demanding more protection for holding duration risk. So all those factors combined explains this meaningful rise in rates over the past month. It's not just say one inflation factor alone.
You put all of that together, there's always so much going on these days, but you put all of that together for a fixed income investor. How should they be thinking about the path forward?
So with the meaningful reprice higher of the interest rate, if you look at the valuation right now, the market is basically priced in a terminal rate of around 4% for Federal Reserve. Compare that to the Fed's long-term neutral rate forecast of just 3%. So there's roughly a 1% gap. That is, I would say, relatively unusual for the market who follow the Fed very closely. And to us, that signals that the long-term expected return potential for U.S. Treasuries is attractive at this level. That being said, I will caveat by saying that in the short term, realized and expected volatility on the rates front could be pretty volatile. Not the least because of high policy uncertainty we're going to have with the Trump inauguration next week. And so for now, for investors who want to be more tactical, we think one can still be cautious on adding duration to the portfolio.